So you're getting close to retirement, or maybe you're already there. You've probably heard a million times that market crashes are just temporary, that you should just ride them out. But what if I told you that for a retiree, that's not always true? For someone taking money out of their portfolio, a crash can be a permanent, unrecoverable blow. Today, we are going to break down exactly why. Let's just dive right in with a simple question, but one that's, well, honestly, it's kind of terrifying. Picture this. You've worked your whole life, you've saved, you've planned, and the market crashes on the very day you retire. What happens next? The answer to that question reveals a massive risk that, frankly, most people just don't see coming. To really see this in action, let's imagine a tale of two retirees. We'll call them retiree A and retiree B. Now look at this. They are identical in almost every way. Both start with a cool $1 million. Both plan to withdraw 50 grand a year to live on. And get this, over the course of their retirement, they will experience the exact same average market return. The only difference, the only one, is luck. One has bad timing, the other has good timing. Okay, the great divide, the saver versus the spender. You might be thinking, why does luck suddenly matter so much? Well, it's because the day you retire, you cross this invisible line. You fundamentally change your financial identity. You stop being a saver, someone who puts money in, and you become a spender, someone who takes money out. Think about your financial life in two phases. While you're working, you're in the accumulation phase. Cash is flowing in. Your 401k contributions are buying stocks every couple of weeks. In this world, market dips are actually your friend. You get to buy more shares on sale. But the second you retire, boom, you hit the decumulation phase. Now, cash is flowing out, and that same market volatility becomes your worst enemy, because you might be forced to sell your assets when prices are in the gutter. While you're working, you have this amazing superpower called dollar cost averaging. You invest a set amount of money from every paycheck, right? Well, when the market drops, that same amount of money automatically buys more shares. It's like an automatic buy low strategy that's built right into your savings plan. It's your best friend. But here's where it gets really scary. Your best friend has an evil twin. Dollar cost ravaging. This is what happens when you're retired. To get that fixed $50,000 a year in cash when the market is down, you're forced to sell way more shares at those rock bottom prices. This doesn't just lock in your losses. It carves out a chunk of your portfolio that can never grow back. It ravages your nest egg. This brings us to the main villain of our story. This whole destructive force has a technical name, and you need to know it. It's called sequence of returns risk. It's the danger that the timing, the sequence of your investment returns, especially right at the beginning of your retirement, can completely derail your entire financial future. So let's go back to our story about retiree A and retiree B and see this villain in action. Remember, they've got the same amount of money, the same withdrawal plan, and over their lifetime, they'll get the same average returns. But their timing, their sequence of returns is completely different. Okay, look at this. In their very first year of retirement, it's a catastrophe for retiree A. The market tanks 20%. Their $1 million immediately becomes $800,000. Ouch. But then they still have to withdraw their $50,000 to live on. At the end of year one, they're left with just $750,000. Meanwhile, lucky retiree B gets a nice 10% gain. Even after taking their 50 grand out, their portfolio has actually grown to over $1 million. What a difference a year makes. Now here is the absolutely crucial point. For retiree A, that double whammy, a huge market loss combined with a necessary withdrawal, creates a devastating snowball effect. Their portfolio is now so much smaller that it has to work exponentially harder just to get back to where it started, all while they're continuing to take money out of it every single year. It's a hole that's incredibly hard to dig out of. And here is the jaw-dropping, long-term result. We fast-forward 17 years. Even though the market recovered and both of our retirees got the exact same average return over that period, retiree A is broke, flat out of money. That one bout of bad luck at the beginning was fatal to their plan. Meanwhile, retiree B, who had the good luck up front, is still thriving. This just perfectly sums up the harsh new reality of retirement investing. It's not just about how much your portfolio earns on average anymore. It's about when you earn it. This sequence matters. And as we just saw, those early losses can hurt exponentially more than later ones. Okay, I know that's a scary concept. It is. But it is not hopeless. You are not powerless here. While you can't control what the market does, you can absolutely control your strategy. So how do you build up your defenses against this nasty sequence of returns risk? One of the most popular and, I think, smartest defenses is something called the bucket strategy. The idea is simple. You segment your money based on when you're going to need it. So, bucket number 1 is pure cash, enough to cover 1 to 3 years of living expenses. This is your rainy day fund, your fortress. If the market crashes, you live off this cash and you don't have to sell a single share of stock when it's down. Bucket 2 is for your medium-term needs, say years 3 through 7. That's in more conservative stuff like bonds. And only bucket 3, the money you won't touch for 10 plus years, is in stocks for that long-term growth. And that's not the only trick up your sleeve. There are other powerful tools for your toolkit. A big one is having a dynamic withdrawal strategy. Sounds fancy, but it just means having preset rules, like guardrails, to maybe trim your spending a little bit during down years. Instead of selling more shares when they're cheap, you just tighten your belt a little. Diversification, of course, is always key. And maybe the most powerful tool of all, if you have the flexibility, just delaying retirement by a year or two to avoid retiring right into a crash can make a world of difference. And look, this risk is so real, so well documented, that it is literally changing the fundamental rules of retirement planning. For years, you heard about the 4% rule, right? The idea that you could safely withdraw 4% of your portfolio each year. Well, new research from finance giants like Morningstar suggests that for 2026, a safe rate is actually closer to 3.9%. And a big reason for that adjustment is to build in a bigger buffer for this exact risk, the risk of a bad sequence of returns. So what is the big takeaway here? What should you walk away with? It's really about making a mental shift. It's about moving from thinking of your portfolio as this fragile thing to building a resilient, all-weather income machine that can handle some bumps in the road. If you remember just one thing from our time together today, make it this. When you stop putting money in and you start taking money out, the order of your returns becomes every bit as important as the average. That, right there, is the heart of sequence of returns risk. So the final question, the one I want to leave you with, is this. Is your retirement plan just built on hope and averages, or is it truly built to withstand a bad sequence? Because when it comes to securing your future, preparing for bad luck is the only way to guarantee you won't need good luck to succeed.